Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Jourdain. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Mike Wilson's capitulated. He's moved from 4,500 to 5,400 and all of that. Can we just start with the skew, the wide range of outcomes? Because that was the headline of the piece. The bear case versus the bull case, has it ever been this wide?
Well, not for us. I think for other people, they've had wider skews. And look, it just reflects the uncertainty that has been the case for the last several years. And quite frankly, I wouldn't be surprised if we hit both sides. That's kind of the world we're in, which is, think about this year, and we talked about this at the beginning of the year, which is we had three sort of equally similar sort of outcomes. One was a soft landing, just the Goldilocks, which is kind of consensus now, and that's our house view. Then you have the no landing, which is kind of a reacceleration, the stickier inflation, even maybe a stagflationary outcome, which is what the market was thinking about in April. And now you're back to a soft landing, but you still can't rule out a recession either, right? So all of these are very possible, and they could all happen with a higher than normal degree of certainty. So that's really the headline that should have been out, is that look, nobody knows anything, right? And particularly at a point in time, and I think maybe our mistake is just admitting that we don't know as much as maybe everybody else claims to. That's called humility, something that we've learned the hard way over life. But anyways, the point here is that the meat of our report this year, or this update, was really more about how do you make money in an environment where you have basically 0% upside and the base case, and you could have 20% upside or 20% downside. And that's what clients pay us for, right? It's the process, it's understanding, okay, what kind of environment and how are we going to navigate that and manage that? So we spent a large part of the report yesterday talking about trade ideas, specific sector ideas. That's not the headline that people wanted to write about. That's fine, that's your prerogative, but that's what we want to talk about.
That was never going to fit in the headline. No. We will talk about some of that stuff in just a moment. Let's talk about the headline just briefly.
Sure. Are
you de-emphasizing the 5,400? Are you saying as a price target it's not actually that important to you in a firm? What is that?
Well, it's not important to most clients. Institutional clients don't care about the target on the S&P 500. Let's be honest. They're trying to pick stocks. And look, one of the most important things we talked about in the report is alpha generation this year has been spectacular. The way we measure it with our client base, which is significant, is this is the best alpha generation, alpha capture we've seen since we've started recording it since 2010. So that's what people care about. We're trying to help them in that their process of, okay, what kinds of stocks work in this environment? Oh, by the way, when we skew from these different outcomes, you need to be ready to pivot towards different types of securities. Right now, our house call is it's a soft landing Goldilocks outcome. We're not that confident that we want to make that bet fully. We think it's still late cycle, which means quality. Okay, large caps over small caps still. We like staples over discretionary. We have two defensive sectors overweight, utilities and staples, because that kind of protects against slowing growth risk. So there's a bunch of different things, but the main factor that's been working is quality. Quality's been the most consistent factor, and we don't see that changing.
I just want to say that if you wrote a headline saying nobody knows anything, we could do that every day, but it probably wouldn't really gain that much attraction. I am wondering if there are certain areas that would win in either scenario, the 5,400 or the 4,500.
Well, I think that we laid it out. Once again, that's our bear case. A 4,500 scenario that's not really our bear case. That's our base case for year end originally. That obviously has proven to be wrong, mainly because of multiples. Right. I think this is the main thing, Lisa, that people have either gotten right or wrong in the last 12 months is that, a 21 multiple is, in the top decile of the last 80 years. That is an expensive multiple. So the question I think investors have to ask themselves is that a fair multiple to be paying? Well, in the Goldilocks, perfect soft landing, I think that's plausible. But that's where we're trading, and that's why there's not a lot of upside at the index level.
Which raises this question, are there specific sectors that win regardless of the overall index? Do you see certain areas that are kind of independent of this overall shift of whether there is this momentum and international money that pours in and keeps valuations high and sets them higher?
It's large cap quality. That is what continues. And by the way, it's not just high growth, it's also cyclicals can work in that, but it's still up the quality curve. and we show it in the note very clearly. I mean, it's been the best carry factor for the last year and a half, which is a classic late cycle winner, which is where we are. So, don't overthink that. And don't try to be cute and say, well, I'm going to jump over here because I think there's better returns. There could be. Look, in the small cap and in the lower quality areas, you can't own nothing. I mean, but it's very idiosyncratic. It's very idiosyncratic. It's not a factor that's carrying well. It's okay, I have a stock-specific idea. It's a low-quality stock, potentially, that has a very unique story to itself.
Next big stop for this market, as you know, is tomorrow afternoon. We get numbers from NVIDIA. Mega cap tech, what supports that 5,400? What supports it for you? Is it mega cap tech, the NVIDIAs of this world? Is it elsewhere?
Well, it's basically you're assuming that multiples stay elevated, right? We didn't change our earnings forecast in this report, but we've had this sort of boom idea that we had the boom bust thesis for a while. We probably were early in calling for a recovery in earnings this year and in 2025. So that didn't change. So you have earnings coming from a lot of different groups now. I would say the biggest contributors have been technology. Energy has been a big contributor, surprisingly. Industrials, because of all the spending that's going on fiscally. So those are three major sectors that are contributing to the earnings story. But ultimately, the 5,400 is being supported by policy, right? By very loose fiscal and monetary policy. Now, you may say, well, monetary policy is tight. Not really. I mean, we have an incredible amount of liquidity coming in to pay for that fiscal. So to me, the risk in the story for the next 6 to 12 months is, do the markets start to balk at this unsustainable fiscal policy and the way that they're funding it? And we wrote about this, in detail. We have these liquidity provisions in place now. The reverse repo, which everybody knows about. The Treasury General Account can be drained if necessary to pay for fiscal stimulus in the budget if they need to. And the Fed has already said they're going to start tapering QT. Well, that's like $1 trillion of liquidity. That's pretty loose, right, to pay for the fiscal. So to me, and I think this is something we're watching very carefully. Last fall, when multiples came down hard, it was because rates were going up due to term premium widening, meaning the bond market was starting to push back on this strategy. Right now, that's not a problem. So one of the things we're going to be watching this, to change our view on how things trade at the index level is, does the term premium start to widen again? We don't know, but that's what we're going to be watching.
So big risk factor is in the bond market. And in the bond market, the big focus is November. Does this have a political twist to it? An election call embedded in it?
Well, I mean, yes and no, because I wouldn't say either party has shown any fiscal discipline, right? So in other words, I think we're going to get a strong fiscal support no matter who wins the election, both in Congress or at the presidential level. The real question for markets is, how does it get funded? How is it funded? Can they fund it at a reasonable rate? Right now, the bond market seems very relaxed about that feature, which is why multiples have expanded again.
So if the bond market stays relaxed about this, which there's a lot of people predict that it will, and believe me, I get very excited about auctions, but every week people tell me that I shouldn't because there's plenty of interest at these levels. If there isn't pushback, then 5,400, is that too conservative?
Maybe. It could be. I mean, look, I can make a case for 17 times, which is what our target was originally for this year, 17, 18 times. I can make a case for 21 times. I can make a case for 22 times. That's the problem, right? We don't know. So that's why we have a wider skew. And I would say this, Lisa, that the target will be more determined probably by multiples than we're going to be wildly surprised on earnings, okay? Unless it's a recession, of course, then you'll be surprised on the downside. But I don't like the earnings haven't really moved that much for 2024 and 25, right? If you think about since October, which is where the low last fall, 2024 earnings estimates are up a couple percent. The market's up 25, 30. So it's all multiple. So this is why you just need to be alert to things changing potentially in the bond market first, and then that will feed into the equity multiples.
When you talk about fiscal spending, to go back to Jon's point earlier, in the election, it's very different what the fiscal spending may be used on depending on who wins the White House. You're talking about potentially industrials, the green energy economy. This is a new industrial policy from the Biden administration that could continue or could stop short if it's Trump. How are you thinking about 2025?
Well, I mean, look, I think the industrial policy will remain strong. I mean, that's a reshoring thing, which was part of the Trump administration. So half of the industrial policy is potentially green energy, and half of it, I would say, is reshoring and the deglobalization trend. So there's going to be spending either way. It may be redirected. Like I could see maybe the energy policy shifting back towards traditional energy, but I would be surprised if spending is curtailed in a meaningful way from that standpoint. I think we'll see changes or differences maybe in the tariffs, although recently that seemed to be more aligned. And then, of course, immigration is a big one. And that was a huge surprise this year that really nobody saw coming around the positive labor shock from immigration. So to me, that's probably the single biggest wild card, depending on who wins the election.
Bigger, not tighter, is the view coming from Alan Zentner and the team at Morgan Stanley. This economy can grow without it getting tighter and generating inflation pressure. Are you saying that could flip the other way pretty quickly based on the outcome of the election?
I think depending on how things behave, if policy really changes, but yeah, sure. If you all of a sudden shut the borders down, and Trump's talking about deporting people, that would be a negative labor shock, and then we'd be in a reverse situation. So, look, right now I think the election is literally a 50-50. I mean, the polls are right there, 48, 49, 50% for both sides. So this is not an issue yet. We talked about this in the note too, which is that volatility in election years typically doesn't start picking up until August, September. So I think it'll be okay for the next month. This is not going to be a topic, but it can come at us quickly, probably post the conventions.
With us around the table, Deutsche Bank's Matt Luzzetti. Joining us also, Aberdeen's Luke Hickmore. Luke Hickmore, if I may, go through the lineup again today. Williams, Bostic, Barkinbar, Waller, Collins and Mester all speaking once again. Luke, what is left to know that we don't know already from these officials?
Yeah, it's tough, isn't it? I mean, we were talking about Table Mountain earlier in the year, and it feels they're all on deck chairs, waiting around at the top. Can't see a thing below them. And if you've ever been there, it's like that so often. And that lack of visibility, it's useful to have all these Fed speakers with us now to get a sense of where they are, what they're thinking. But they don't see any further than we see. And we need to see the data change. I think it is changing. I think there's early signs of it changing, and they need to see the data change. So I think this whole thing that Mike was talking about with the 3-month visibility period feels about right. September feels about right. But in a year's time, we'll be 100 basis points lower rates.
Matt Luzzetti, have you heard enough?
A Fed speak?
Yeah.
Yeah, I think we're hearing obviously a packed calendar today. A lot of it is not related to the outlook. We have a lot of commencement speeches on the docket. So I'm focused on a few things. One, we had Jefferson yesterday. I think hearing from the vice chair is important. He noted that the Fed's forecast essentially for core PCE at the end of this month is basically 26 basis points. We're talking about getting progress. That is definitely progress from the very strong prints that we had earlier this year. But we also have to know the context that it's still well above the Fed's objective. It still annualizes to above 3%. Today, I would highlight Governor Waller. In the past, he has given actually some decent forward guidance about the data he's looking at, the number of prints that he would likely to see. Perhaps he doesn't go that far. I think the Fed has fully pulled back from calendar-based guidance at this point in time. But the reality is the Fed is highly data dependent. Forecasting the high-frequency data is hard in this environment. And so the data should do more in terms of market moves than the Fed speak should.
Luke was saying that he thinks that you actually are starting to see a turn in the data. There is something going on under the hood that's consistent. Do you agree, Matt, that there is this feeling, not only disinflation, but weakness that's coming through maybe more than the overall data might suggest? Yeah,
you look at economic surprises, they're negative now on average. The inflation data did improve in the last month, but it's too high. The Fed needs a lot more evidence on that. Some caution I have around these 3-month rates that everybody's talking about. Everybody thinks that there's residual seasonality in the data. We get stronger prints earlier in the year. We get weaker prints in the back half of the year. If that is true, and I believe it is, the Fed should be cautious about overinterpreting 3 months of data if it does improve. More broadly, you had some give back on the retail sales data. That was probably welcome from the Fed's perspective. You have a labor market that did soften a little bit, but the context is we grew above 3% last year. Atlanta Fed is tracking very strong GDP growth for Q2. It is softer, but it's not obvious at this point that it's soft enough to get inflation back down to target.
Softer, but not soft, as John's been talking about quite a bit. I am wondering, Luke, from your perspective, if there is a signal within specific areas like retail sales, where we see this discussion around more discretion, price cuts from Target, all of these types of things that are leaving us feeling like things might be shifting, but not enough to change the narrative. How do you interpret this?
Yeah, I'm that consumer thing too, but I'm also looking at what's going on with companies. Are they spending? Are their CapEx plans growing? And they're not. The federal budget is probably at peak for now. That's starting to be less of a stimulus going forward. So consumer may be stalling, maybe not going down, but stalling. Companies are happy to hang on to cash, quite frankly, and the federal government participation may be easing off a little bit. All of those are just those early warning signs. I mean, it may be that all passes in the next 2-3 months and we get back and stay at these levels of interest rates through next year. But I don't think that's where we are. I think we are in a period where that inverted yield curve is starting to bite, is hitting consumers, companies, and the fiscal side from the government's changing.
Matt, you read a lot about the labor market in your most recent note. What are these factors that can be a tight labor market but also low churn?
Yeah, so the labor market is fascinating at the moment. You have a very low unemployment rate. We're churning out 240,000 jobs per month on average over a 3, 6, 12-month period. At the same time, when you look at some of these other indicators, the quits rate, the hiring rate, it actually does show what looks like some weakness. The quits rate is the lowest since 2018. The hiring rate is the lowest since 2014. Those are typically associated with a much higher unemployment rate, probably something in the 4.5% to 5% range. So understanding what's going on there, I think, is absolutely critical. It is the result of a very low layoff rate. Now, I don't think it's just about labor hoarding. If it was just about labor hoarding, you expect productivity growth to be quite low. Productivity growth over the past year is actually quite strong. You expect people not to be working their workers very long hours. That's not really happening. So I think we don't understand it all that well. I speculate that this big burst in labor market churn that took place, basically everybody was able to quit their jobs around the pandemic, and it led to this much better matching between employers and employees. We also have a lot more flexibility in the labor market with work from home. If that's true, you should have less people quitting their jobs, less layoffs taking place, less hires, but also big productivity gains, which is at least is what we're seeing over the past year.
Mid-cycle adjustment. It's a phrase that I first read in your research. I think a lot of other people started to think about it in the months afterwards. You've put forward this idea that what we're going to get is a couple of cuts and maybe that's it. A higher neutral rate as well. What underpins that view? Where did that come from, Matt? Because the world seemingly is coming around to your perspective.
Yeah, so I think when you look at the Fed historically, oftentimes they are cutting because they're seeing recessionary dynamics at play. And when that happens, they cut aggressively. They cut well below what they think the neutral rate might be. We have 2 historical examples where they're not cutting because we have a weak economy, but they're cutting because maybe there's some downside risks or inflation has come off a lot. That's the mid-1990s and 2019. Both episodes had 3 25 basis point rate cuts, the mid-cycle adjustment. So as we look at the outlook, and if we think it is only about inflation, at least up front, I think it's more likely the Fed does, call it 325 basis points, pauses at that point in time until they either see some weakness in the economy or inflation is all the way back down to their target.
I'm going to get to Luke in just a second, but Matt, just to follow up then, doesn't a mid-cycle adjustment indicate that we have some idea of what the neutral rate is?
I think the mid-cycle adjustment gives you the sense that they think they're well above where the neutral rate is.
Are they?
I think, according to any metric, they are. I mean, I don't think it's as low as the 2.6% they have in their long-run dot plot. We think neutral in nominal terms is somewhere closer to 3 3/4 to 4, which is at the upper range of what everybody's saying. But we're still 150 basis points above that range. So I do think that they are restrictive from that perspective. I think it will flow through to the economy over time, and they can take out some insurance rate cuts. But there's massive uncertainty about where neutral is. And so just plowing forward to what they think neutral is probably not the correct path.
This is actually one of the critical questions for investors. And Luke, I'd love you to weigh in on this because we were talking to Mike Wilson earlier. And frankly, one of the biggest mysteries to him has been the interplay of incredibly loose fiscal policy and monetary policy that's restrictive when it comes to rates, but not necessarily beyond that with balance sheet issues and the repo lines. What's your take on just how much you're following what the Fed does, not just with rates, but beyond, and that interplay in order to just get more and more bullish because there's just still so much liquidity in the market?
You need that liquidity to be always increasing. And I think with that's behind us. I think we are going through balance sheet roll-off. I think we are going through that shift in how the Fed tries to control the economy. It's more interest rate-led than every other tool that they've used in the last 15-odd years. And that should start coming through. At the moment, it's not. You're right. The liquidity is massive. Credit markets are seeing new issues like we have never seen. And that's soaking up money too. But again, unless it's incrementally increasing, we will start to see that delta start to hit us over the next quarter, 2 quarters, I don't know. It will come through this year, for sure. So it does come back, doesn't it, about do the Fed need to act? And are they better to start acting before they have to start acting? And as we were saying earlier on, normally we get fast rate cuts. This time it's slow rate cuts. Say 2 this year, 2, 3 next year. I'm probably a little lower than that. I think on the neutral rate, maybe 2.5 to 3 rather than something over 3.
Yeah.
But we do need to see evidence that inflation's okay into the long term as well.
Luke, I've got 10 seconds. Give us a trade. What's your favourite right now?
Short call AT1. 7.5%, 8%. No interest rate risk and very little risk of not being called.
Luke Hickmore, thank you, sir. Appreciate it. Deutsche Bank's Matt Luzzetti alongside him with Aberdeen's Luke Hickmore. Gents, appreciate it. Thank you. Lowe's beating sales estimates and Macy's beating profit estimates. The department store warning that consumers will remain, quote, discerning in their discretionary purchases. Chuck Grom of Gordon Haskett writing this: if trends have seen a further step down, this would suggest to us that deeper consumer issues are surfacing, which would be most problematic for the lower income off-price retailers. Chuck Grom is with us from Gordon Haskett now. Chuck, let's start with Macy's. What do you take away from a raise to guidance, but ultimately, once again, conveying that consumer is somewhat cautious?
Yeah, I mean, the Macy's numbers were decent this morning. Comps came in a little bit better. Gross margins, however, were weaker. They noted in their release they had to move some summer seasonal and spring seasonal items to get inventories in better shape. So that was smart for them. And then they essentially kept guidance intact. They nudged it up both the low end and the top end by about 5 cents. So what we can take care, and you can also look at the Lowe's numbers, which also came in a little bit better. You can see the pre-action on both stocks that the numbers weren't terrible. More much worse than expected, but we do agree. We think the consumer is discerning right now, and we expect that trend to probably continue for most of the year.
Were the numbers better than expected because these retailers are doing a good job at figuring out where consumers are willing to spend, or are they better than expected because the consumers may be discerning, but they're still spending quite a bit?
Probably neither, actually. I mean, most of the beats are really below the line. And in case of Macy's, their SG&A rate was a little bit better. And in the case of Lowe's, the gross margin's actually a little bit better. And like I said, the top line pretty much intact, a little bit better. So we'll see how it plays out over the next few days. We have a lot of earnings coming up with Target and TJ tomorrow, followed by BJ's and Ross on Thursday, and then a lot more actually next week as well.
Chuck, when it comes to Macy's, we've been looking at the Bluemercury numbers versus flagship Macy's, and Bluemercury is doing very well. What does that tell you about the state of the consumer on the upper end and the lower end?
That's a great point, actually. Bluemercury numbers were up, I believe, 4.5% relative to Macy's being down. Bloomingdale's pretty much flat. I mean, I think what we're learning is the lower income customer is under the greatest amount of stress. The upper income customer, because of housing prices and where they are, and the wealth effect of the equity markets being strong over the past couple of years, are more resilient. That's not new. I think the question, and Mohammed pointed out in his pre-comments, are we going to see the middle income start to come under pressure? And that's something we're going to, try to discern over the next few days and into next week.
Chuck, do you think Target might give us some information on that front?
Well, I mean, Target's numbers should come in close to expectations, down 3 to 4%. They did announce, surprisingly, a big rollback program by lowering the prices on close to 5,000 items. Is that reactionary? Is that proactive? We'll find out tomorrow. Given what Walmart's been doing on rollbacks, I think they noted that their rollback count is up 45% in the first quarter. The consumer's looking for value and looking for lower prices, so it's intelligent on the part of Target to do that. Is that supplier funded? Is that coming out of their own pocket? That's something we'll be looking for clarity on tomorrow morning.
Yeah, that's the margin question, Chuck. What's your base case on that question?
I think it's probably a combination of both. I think a lot of the suppliers are looking to move units, and I think that in that case, that if it's similar to what we've heard out of Walmart, I think it's probably margin neutral. But again, we need to hear from the company to learn more on that. But like I said, I think it's a smart and proactive thing to do, given that the consumer wants value. Historically, Target's prices tend to be 5 to 10% higher than Walmart, so it's something they need to address, in our opinion. Are they funding that through their media network? Are they funding it through other parts? That's probably the case, is our assumption.
Chuck, when Walmart say trade down, are they saying trade down from Target? Is that who they're talking about? Who loses when they talk about that theme?
Yeah, I mean, it could be Kroger, it could be Target, it could be all the above. It's probably Target to a degree, though. I mean, that tends to be where the greatest customer overlap is. And as you heard from Walmart, the greatest share gains they had last week was on that upper income customer, the customer who makes more than $100,000 a year. And the key for Walmart, really, they saw this coming out of the global financial crisis 15 years ago, but they did not retain those customers. And that's the real opportunity for Walmart. And that's why they're doing more rollbacks. That's why they're investing in store remodels. So we think the prospects are good there for Walmart to retain those customers.
Interesting. Chuck, one of the best. Thank you, sir. Almost there. Feels like such a long earnings season. Chuck Grom there.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.